Viewers at home, welcome again to another interesting episode of Insights from Eximeters Legal. Today we will be discussing something very important and germane to taxation under commercial law, which is the principles of taxation. And we'll be talking about the general principles of taxation. We'll also be discussing tax law in Nigeria as a case study. My name is Esther, your host. Welcome once again. So what's taxation? Taxation has its roots basically in law. And many scholars have defined taxation in different ways. But as a layman will understand, I need to first of all lay the foundation that taxation is a major source of revenue for government. Modern day system of tax follows same pattern of contributions from the individuals to the government purse. So it's something that companies, individuals, juristic personalities, which are companies, are levied to put funds into the government purse for the development of the society, development of infrastructure. So there is no country, no sovereign nation that ideally can survive without an adequate tax system. And so the concept of taxation is very, very important, and it dates back to long before the 18th century. So there has been tax even in the colonial era, different forms of levies and rates being imposed on individuals. So what's taxation? It has been defined by different scholars. Some defined it as a machinery or process in which society and communities, or a group of individuals, or a company, corporate bodies, contributing an agreed sum, which is important for the development and administration of the public, of the society. Some has defined the tax as a compulsory contribution to the support of government levied on persons, property, income, commodities, transactions, at a fixed rate provided under the law, under the tax law, based on the person or group of persons or corporate bodies that are being levied. And most of the rates, most of the time, are proportionate on the amount of, to the amount of contribution being levied. So it is very important to understand that tax, their rates, their levies, being imposed by the government of any country on either the persons, individuals, on their personal income, on their salaries, on the corporate income, that's the profit of a company, and on certain commodities or properties in the jurisdiction. So we want to go further and discuss what exactly is tax using Nigeria as our case study. There are different and various laws in Nigeria that presents an insight into the different taxes being imposed in Nigeria. I need to say, under the tax law, there are concepts of residency, which is very important, and non-residency. Whether an individual is resident in a country for a particular length of time, as prescribed under the law, will determine whether the person will pay tax in that jurisdiction or not. Ordinarily, under the tax law in Nigeria, there's a definition of who is a resident. Somebody who has stayed in the country for more than 180 days at a stretch is considered to be a resident in Nigeria, for instance, and definitely will be expected, if working, to pay tax on his or her income being earned in Nigeria. So that's very, very important. And yes, in other jurisdictions, they could make provision for even monies earned in other countries. For example, in the United States, as long as you're an American citizen, you have to be able to declare when you are filing tax in America, even your income from other sources outside the United Kingdom, especially if you are having an account that has more than $10,000 outside the country. The financial reporting obligation in the United States provides for such declaration. And even such amounts could also be taxed even in the US, even though the person is ordinarily not resident there, but has other businesses outside and is an American citizen. So you can imagine that tax is very dynamic, and it has put a lot of companies, even individuals, into a lot of problems when it's not properly managed. And it could be a criminal issue when tax is being evaded. We're going to discuss that. So we're discussing Nigeria as a case study. What are the taxes provided for under the tax law in Nigeria? One, we have the company's income tax. As the name implies, it's the tax that levies, that places a particular levy on the income of companies. So this is a tax imposed on profits of a company from all sources. So it's one of the main taxes administered and collected by the Federal Inland Revenue Service in Nigeria. I need to say and emphasize here that we have two major regulatory bodies for tax in Nigeria. There's a regulatory body that deals with tax at the state level, and there's also another regulatory body that deals with tax at the federal level. So companies operating in a particular state, individuals, personal income tax being earned in a particular state where somebody is earning salary. Take, for instance, Nigeria. I'll say Lagos State. Lagos State is a metropolitan city and is big enough, known all over the world. So in Lagos State, for instance, an individual working in Lagos State is expected to pay tax in Lagos State to the State Inland Revenue Service of Lagos State, not the Federal Inland Revenue Service. The Federal Inland Revenue Service focuses attention on companies, limited liability companies in the country. So any company, albeit located in any state in Nigeria, will remit taxes to the Federal Inland Revenue Service. So that's very, very important. So company income tax is a tax majorly imposed on profits of companies from all sources. So it's mainly administered by the Federal Inland Revenue Service. In Nigeria, we call it FIRS. It's a tax paid on the income of incorporated companies. So company income tax is basically regulated under the Companies Income Tax Act in Nigeria, Cap 21 Law of the Federation of Nigeria, 2004, as amended. And the rate on this tax, ideally, is 30%. Government has the prerogative from time to time to change tax rate. Of course, not arbitrarily. They have to look at the economic situation, the monetary policies and all that. So at the moment, it's 30% of the company, of the total profit of that company. Of course, less all expenses. There are allowable expenses under the law, under the tax law, that companies can deduct from their profit before arriving at the amount that is taxable. So we have something in tax what we call taxable income. So majorly, it's not all income of an individual or the company or a company that is taxable. Certain deductions are allowable under the law, and these are specified in the tax law. For companies, it's specified in the Company Income Tax Act in Nigeria and also in various jurisdictions. Because don't forget, our tax law in Nigeria is a replica to a large extent of tax laws in some developed nations like the United Kingdom. So these things are relational to what obtains in other jurisdictions. We're just using Nigeria today as a case study. So certain expenses will be deducted, then the taxable income will be arrived at, then the company can now charge and assess the balance of that income, which is taxable, at the rate provided under the law, which for companies is 30%. And eventually, that's the taxable profit of the company. There are instances where the company does not make a profit at a particular year, financial year. And of course, it will declare that it doesn't make a profit. Under the law in Nigeria, we also have instances where companies for the first 3 years of their establishment are given tax waivers, but they have to collect like tax clearance certificate, to show that, okay, for the first 3 years, the company is still developing. These are measures of incentives, that in Nigeria, the government allows for to encourage businesses to grow. And we also have some companies in greenfield projects. Those are projects that are like novel projects, sectors where the government wants to really encourage. Let's say, for instance, in certain areas of agriculture, there could be pioneer tax regime imposed. We're going to discuss that eventually in this series. So these are like a period of time, maybe for 5 years, such a company is not allowed to pay tax, and the government will give the tax clearance certificate once it's applied for. We also have the personal income tax. So this is a tax imposed on income of individuals, employees of companies. When I was explaining earlier, I said if, for instance, if somebody is working in Lagos State, the salary of that person is taxable. So the company where the individual is working is responsible to make sure that tax is deducted from the salary. Also, personal income tax is also levied on sole corporates or body of individuals, communities. When we say sole corporates, so like sole proprietorship, where it's maybe like a one-man business, they will remit such tax as personal income tax. But a body of individuals, communities, families, trustees, executors to an estate are also liable to personal income tax, as the case may be. So it covers taxation of sole traders, this personal income tax, partnership assessments, taxation of estates. So the personal income tax is regulated by a different act. For instance, in Nigeria, it's regulated by the Personal Income Tax Act. P8, Chapter P8, Law of the Federation of Nigeria, 2004, as amended as well. So we have different acts promulgated, enacted at different points in time for different types of taxes in Nigeria. And these are like in quotes, the guidelines that the tax authority will use in assessing. So the relevant tax authority under which the personal income tax will be assessed is majorly the various states' boards of internal revenue. Some call it inland revenue. In the US, they call it ILRS in Lagos State. In the US, they call it ILS. So different internal revenue service, IRS. So different jurisdictions, different states have their own mode. But in Nigeria, the state boards of inland revenue for each state will manage the personal income tax. We also have the value-added tax. This is a very interesting tax. And recently in Nigeria, it has really caused the buzz. Because now the Federal Inland Revenue Service makes it very mandatory for companies to make sure that VAT is paid on certain items. And I've seen in practice where companies have been made seriously liable for not remitting the VAT. So it's a very serious issue under the law. Value-added tax, this is a tax charged on the sale of specified goods and services. So there are certain goods and services that value-added tax is being charged on. And the rate in Nigeria at some point was 5%. However, recently, about 2 years now, 2020, the company raised the VAT, that's the acronym for value-added tax, to 7.5%. So when it was 5%, the prices of commodities actually hadn't really gone up. But there is always a corresponding increase in prices of goods and services when the value-added tax rate increases. So now at 7.5%, of course, it increased the price, the market price of most commodities, products and services in the market. So this tax is charged on sale of specified goods. So there are vatable items under the law. And it's majorly charged on consumer goods. At times it's referred to as a consumption tax. So it's mostly borne by the final consumer. And I'll give you an instance. You go to a supermarket. If you check your receipt, you will see that value-added tax has been charged, or the right consumption tax, on some of those items you bought in the market. So the final consumer, those who buy in the supermarket, those who maybe buy certain items that are vatable, will be the one bearing the burden of that tax. The truth is, under the law, tax is a burden, in quotes, and that has to be established. So the value-added tax is regulated by the Value-Added Tax Act. In Nigeria now is amended, but the act still remains 2007. So that's the act that regulates value-added tax in Nigeria. However, the Federal Inland Revenue Service that deals with companies' income taxes, they are vested with the power of administering and managing value-added tax in the country. So this is very, very important. There are vatable items. There are non-vatable items. So every company has to be able to determine, is the product I'm manufacturing or producing, or I'm bringing in or importing or selling, is it under the vatable list of goods or not vatable? There are some items, maybe because the government wants to encourage the sale of it or the production of it, it will not be taxed. So there will be non-vatable items. So there are items, even like in the plastics industry, there are items, some items there that are not under the vatable items because the government wants to encourage the production of such items. So like we said, the current rate in Nigeria is 7.5% for the VAT. We also have the capital gains tax. So this is a tax charged where there's a disposal of assets. So take for instance, somebody sells a property and a capital sum is derived from such property. Ideally, capital gains tax is supposed to be levied. The individual or the company has to declare. But you discover that, of course, in every society, human beings will always find a way to avoid certain payments. but we're talking about the basic principles. So this tax, capital gain tax, they are derived from sale, leases, transfers, assignments, compulsory acquisition, or any disposition of property, chargeable assets. So under the Capital Gains Tax Act, there are things referred to as chargeable assets. And this tax is regulated by the Capital Gains Tax Act in Nigeria under the Laws of Federation, Chapter C1, Law of Federation of Nigeria, 2004, as amended as well. So it's usually charged, this tax has a flat rate most of the time, at 10% on the chargeable assets. So there are assets that are chargeable assets, but they are defined under that Act of Capital Gains Tax. So if one goes to the Capital Gains Tax Act, you see assets that are chargeable, and the rate is 10%. Capital gains tax may not be charged from assets which are not in connection with any trade carried on by the organization. So for instance, the company decides to sell its cars, old cars, but the trade of the company is not sale of cars. We see companies, even in Nigeria, banks, after a while they've used some vehicles for some time, official vehicles, they sell on auction. So such assets, such disposable assets, may not be levied under the Capital Gains Act, since it's really not in connection with the trade carried on a normal day-to-day basis by the organization. Capital gains tax is also not applicable to charitable organizations or educational institutions of public character. This is very important because the government expects corporate social responsibility for organizations. Charities, even if they acquire properties, there are certain exemptions they are given. And CGT, as we call capital gain tax, is not applicable to them. So even if they dispose assets, even if they purchase assets, they don't need to pay such taxes on them. Withholding tax is another tax levied in Nigeria. Withholding tax is a very interesting aspect of tax. And also like VAT, the Nigerian government in recent times too has clamped on companies seriously, especially public limited liability companies, on remittance of withholding tax. So this is a very interesting tax in the sense that it's an advanced tax payment deduction made on any income or disbursement due to a taxable person or a taxable corporation for remittance to the relevant government authority. I'm going to break it down. Take for instance, a vendor renders service to a company. I'll use, let's say, technical vendor provides technical services to a company. He's a registered company vendor with the company. Fine. The amount of payment due to him may be on a particular contract. Let's take, for instance, it's 5 million naira. I'm using Nigeria as a case study. The company will take the withholding tax percentage of that 5 million, holding it as tax advance, remit it to the government on behalf of the vendor. So you can see how dynamic it is. They will remit it to the government on behalf of the vendor. So instead of paying the vendor 100% of the 5 million, they pay the vendor 90% and remit 10%, which is the rate under the law now, to the government as tax on behalf of that vendor. Take for instance here the technical company that is providing technical services. So XYZ technical company provides to ABC manufacturing company. ABC has a right, when he wants to pay XYZ, to deduct withholding tax from the amount from the contract sum. However, there is a caveat. Upon remittance of the withholding tax, there is a withholding tax receipt issued in the name of the vendor, because the tax is paid on his behalf. And that withholding tax receipt, the company that deducted the money and paid on his behalf has to give that vendor that withholding tax receipt as evidence. Because at the end of the year, when the company is also filing its tax, he has to show, yes, I've paid this tax. It was paid on my behalf. And that withholding tax receipt is an evidence. So it's very important. And I've seen, even in recent times now, where companies ensure, especially big companies ensure they go after their withholding tax receipts when they've provided services and such deductions have been made from their contract sum. It's very important. And it reduces the amount of tax they have to pay eventually, because at least a tax has been paid in advance for them. So I believe that I've been able to explain that. So I'll just go further. So like I said, this is an advance tax payment deduction made on any income or disbursement due to a taxable person. So the law, under the tax law, there are taxable persons or taxable corporations. So a taxable person, somebody earning salary, be above a particular amount. Under the personal income tax, there are grades of income, and certain amounts, percentage has to be taken rather from such. So a salaried person is a taxable person under the law, depending on the amount the person is earning. And a taxable corporation is a company that is liable to pay tax under the law. So this advance tax payment is made on any income or disbursement due to a taxable person or taxable corporation for onward remittance to the relevant government authority. Majorly, most of the time, the withholding tax is paid to the Federal Inland Revenue Service, because most times it's the body corporates that really adhere to this withholding tax scheme more. So this tax, when deducted from source, is subsequently, like I explained earlier, remitted to the relevant tax authorities. And the withholding tax rate in Nigeria is 10% for companies and between 5 to 10% for individuals. So there are some individuals that they supply services, they have standard, accounts and all that tax systems, and they are also liable, to withholding tax. So depending on the nature of the transaction, for instance, even in rents, if a rent is being paid to a landlord, especially with companies who are leasing properties from individuals, they tend to take withholding tax on behalf of the landlord and pay in advance. So in that sense, it could be less than 10% because the landlord will be an individual most of the times. And there are times it could be a body corporate. So there are different schemes to these things in practice. So Section 78 of the Companies Income Tax Act provides that where a company makes a payment to another company or to another individual, either as interest with interbank deposit and royalty included, rent, dividend, or any transaction of such a company shall at the time of making the payment deduct an advance tax of 10% of the gross amount that is paid and remit such deducted and withheld tax to the Federal Inland Revenue Service in Nigeria. So you can see what I had explained earlier. So there are nitty-gritties to the issue of withholding tax, but in practice, it is very feasible and is really taken seriously, especially by the Federal Inland Revenue Tax Authority in Nigeria. So we also have what we call the stamp duties. We have the Stamp Duties Act, Chapter 58, Laws of Federation of Nigeria, 2004, as amended. And it regulates stamp duties in Nigeria. So what are stamp duties? Stamp duties could be due from individuals and paid to the respective state governments. And corporate bodies pay their own stamp duties to the federal government. So the stamp duties rates applied by the Federal Inland Revenue Service in Nigeria are in two forms. There's a flat rate charges and ad valorem charges in line with the Federal Inland Revenue Service Act. And the FIRS is empowered to administer these taxes for stamp duties listed in the first schedule of the Federal Inland Revenue Service Establishment Act. These stamp duties are also administered by respective states' inland revenue services. So when we say stamp duties, I'll give a practical illustration. The way stamp duties work, like I've noted earlier, there are two forms. There's a flat rate charged, and there's also ad valorem charges charged, depending on the amount. In most cases, certain agreements, especially loan agreements with big corporates, they are stamp dutied at the Federal Inland Revenue Office. And the Federal Inland Revenue Office could place a percentage based on the amount of the loan. Even in instances of syndicated loans, because I've seen that I've actually done stamp duties of some loan agreements before, especially for big corporates, for syndicated loan arrangements. And it is a prerequisite that they have to be stamp dutied. So the Federal Inland Revenue Service or the State Inland Revenue Service, as the case may be, depending on the nature of the transaction, would charge either the flat rate or the ad valorem charges, depending on the amount. So we also have the custom and excise duties. These are taxes charged at the Nigeria port of entry on certain imported goods. So we're talking about the principle of taxation using Nigeria as a case study. So these are different various taxes charged in Nigeria. Of course, relevant also globally, because we discovered that most of these taxes in Nigeria are a replica of what obtains in the developed nations. So these are taxes charged at the ports of entry on certain imported goods. It's usually administered and collected by the Nigerian Customs Service. When it comes to Nigeria, Nigerian Customs Service. If you go to Ghana, Ghana has their own customs service. You go to Syria alone, they have their own customs service, and they have their own customs and excise duties on their imports. So it's not only peculiar to our country. They could call it different names in different jurisdictions. So the custom and excise duties are levied on imported items that come in. And there's the Custom and Excise Management Act that regulates custom and excise duties. Nigerian Customs Service Authority charges these duties and is a form of tax and levy on imported items. There are two types of taxes, charged at the Nigerian port of entry. So the port of entry, when goods are being sailed into the country. A type of tax is on certain imported goods, and the other is on some exported goods. So you find instances when duties are not only levied on items coming in alone, but items going out. So if you are sending an item out of the country, exporting, that you are going to have financial value on, even if you are sending to let's say you're sending to another sister company abroad certain items here, there are still certain duties that will be levied on them. So on imported goods and exported goods, these levies are made. So customs and excise taxes are imposed on goods either for revenue purposes or to discourage consumption of such products. And this is why, at times also, some could also refer to it as a consumption tax, like the VAT. Because the reason most of the time for the government imposing certain taxes is to discourage consumption of such items. When they know if it's too expensive, then to discourage people from buying. So that's the custom and excise duties. Moving on quickly, we're going to discuss the education tax. This is very peculiar to Nigeria. It's a tax regulated by the Education Tax Act, Chapter E4, Laws of the Federation of Nigeria, 2004, and is administered by the Federal Inland Revenue Service. It's also governed by Tertiary Education Trust Fund Establishment Act of the year 2011. And this education tax is imposed on all companies registered in Nigeria. Well, the idea is to support education in the country. So the rate of the tax is 2% of assessable profit. So there's an assessable profit. When it is calculated, 2% of it will be the education tax payable by the companies registered in Nigeria. So the amount of the fund, the amount in the fund ideally is distributed between universities. So when government collects these taxes, this education tax in the education tax fund is supposed to be distributed among the tertiary institutions in Nigeria, at times based on different ratios as the government prescribes per time. We also have the Petroleum Profit Tax. This tax is imposed on income of companies in petroleum operations, upstream operations. We note that in oil and gas, we have downstream sector and upstream sector. So the Petroleum Profit Tax is imposed on income of companies in petroleum operations upstream. So the tax is governed, when you say upstream now, we have companies like Shell, Total, things like that. They are in the upstream operations. So the tax is governed by the Petroleum Profit Tax Act, Chapter P13, Law of Federation of Nigeria, 2004, as amended. So companies liable to the Petroleum Profit Tax are not liable to companies' income tax on the same income. That is very, very important. Remember, Company Income Tax Act is levied on companies. However, for a petroleum company in the upstream sector, if they are liable to petroleum profit tax, they will not be liable to companies' income tax on that same income because it would amount to double taxation. And yes, and under the law, there's something called double taxation which is being discouraged. So the administration of these laws involves assessment, collection, and accounting for revenues accruing to the government of the Federation. So all these laws we've mentioned above, all these taxes we've mentioned above, they are assessed by the relevant tax authorities, be it Federal Inland Revenue Service or State Board of Inland Revenue Service, depending on the case. The collection and accounting for such revenues accruing to the government of the Federation. So it involves all these things: assessment, so taxes, assessment, collection, accounting to the government of the Federation. So today, we've majorly been able to discuss the principles of taxation. And we're going to continue in this series in our next episode. There are still various aspects to discuss. We want to discuss tax administration, for instance, in Nigeria, how it operates. We want to discuss what is stamped tax avoidance? What is stamped tax evasion? What does the law allow? To what extent can one avoid taxes? Because yes, there are technical areas in law. So we're going to look at some of these things in this series. So today, we've been able to majorly discuss the basic principles of tax. What is taxation? How does it operate? Using Nigeria as a case study, what are the various taxes provided for under the tax laws in Nigeria? And we'll be able to enumerate that currently we have about 9 kinds of taxes being imposed, whether on body corporates or individuals, in the Nigeria economic system. So hopefully the next episode we will discuss what is tax avoidance, what is tax evasion, what are the nitty-gritties of these things, how can we plan taxes. We'll discuss a couple of these things in this series. Thank you very much for joining with me today. And I believe you've been able to learn 1 or 2 things on the principles of taxation, especially as it applies to Nigeria. Thank you. God bless and have a lovely weekend.